There's a lot to get into today, and I don't really know where to start. I guess let's start with the bond market. A lot of things seem to trace back to the bond market the more I look into stuff. It's always a question when you're looking at the economy. The questions of correlation versus causation are why theory is so important. You can't allow empiricism ever to drive your economic reasoning. And when you do, you're bound to just get yourself into a trap because you're really taking a wild guess when you try and use empiricism to guide you rather than using empiricism rather than seeing the data as something that should be explained, rather than using the data to try and extrapolate an explanation from it. I've talked about this before with people when they look at the Phillips curve. For a long time, economists just took it for granted and thought, oh, well, there seems to be an inverse relationship between inflation and unemployment. So if unemployment is going up, we need higher inflation to get unemployment back down, which logically does not make any sense. But because they didn't understand the logic of how the economy worked, these economists just saw an empirical correlation there and said, well, I guess if unemployment's up, we got to create more inflation, better print money, better have a load up the banks and tell the banks it's time to lend out money to folks. And we get a similar sort of thing when we see spikes in the bond market, when yields plunge or when yields go down more than is expected suddenly. There's a lot of things that people just try and pin on this and say, oh, that's why it is. Oh, this is what's happening. They project whatever it is they're concerned about onto the bond market. And it's hard to avoid doing that. So with that said, I'm probably going to engage in a bit of that myself. So I hope you're going to take everything I say with a grain of salt. Because it was funny, I was looking over Zero Hedge's Twitter feed today to see sort of what the mood was throughout the day with the markets. And they were having fun mocking a lot of the big banks who last week seemed pretty bearish on treasuries. There was one post in particular from Morgan Stanley that was pretty witty. It was entitled, Mortimer, sell those bonds, or sell bonds, Mortimer, sell, something like that. It was a reference to Trading Places, the great Dan Aykroyd, Eddie Murphy movie about commodities futures traders back in the 80s. And for those of you who don't know, at the end of Mortimer's one of the characters, and at the end of the movie, I can't remember if it's Randolph or Mortimer. I think it was Randolph based on the way that Zero Hedge worded their response, but Zero Hedge just took that screenshot of sell Mortimer, sell those bonds, and said turn those machines back on, which is what either Randolph or Mortimer says at the end of the movie when the trading day has come to an end and they've lost all their money. And so conventional wisdom apparently was not in line with this continued plunge in Treasury yields, which it's hard to say exactly when it began, but I think that it's certainly a trend at this point, and I mean a recent trend. I'm not talking about the 40-year trend. And believe it or not, I'm actually going to tie this into politics, and here it is. So for those of you who have been bored so far and said, gee, I don't care about stupid treasury bonds, here's the exciting part. What this tells us, I think, part of what the market is saying here by buying up treasury bonds is that they're not afraid of the federal government defaulting on their debt. We get debt ceiling scares all the time, and the media likes to hype it up and say the U.S. government has never defaulted on its debt. Those irresponsible Republicans, or if it's the Democrats, or if it's the Republicans in power, the Fox News will say those irresponsible Democrats, whichever party it is that's in the minority, they don't want to raise the debt ceiling, and they know now is not the time to argue about the budget because our country is about to go bankrupt, and our children and our grandchildren's credibility is on the line. And we get the same old stupid song and dance. And I remember a lot of Republicans during the Trump administration were saying, you know what, this whole debt ceiling thing is really outdated. I mean, we have the Fed that prints as much money as we need anyway. We don't need a debt ceiling anymore because debt doesn't mean anything. It doesn't matter. Debt can always go up. Deficits don't matter. And then all of a sudden, now Biden's in, and they go, oh, deficits matter again, which coincidentally enough was the title of a Paul Krugman column the man who famously said deficits don't matter after the great financial crisis. As soon as Trump was elected, he said deficits matter again. And Krugman I'll give a little more crap for, because Krugman is supposedly a Nobel Prize winning economist. He's supposed to be a respectable academic, when in reality he's just a political hack, much like all these folks in Congress, no matter what party they are on the debt ceiling thing. I've been watching this closely, I guess, really since Obama was elected. That's kind of when I really closely started following politics, was when I got into middle school, around that age, kind of, maybe a little younger. And so if there was really any risk that the federal government is going to default on its debt, which means not pay their bondholders, not roll, because the way they do this is the way that this works. When they say, oh, the government's going to default on its debt if you don't raise the debt ceiling, that's because they're saying, if we don't raise the debt ceiling and can't issue new bonds, we're going to stop paying on the old bonds, and we're just going to spend all the money that we have coming in through taxes, because again, the government does have cash flow. They have taxes coming in. We're not going to take that cash to pay down the bonds that we already have. We're going to take that cash, pay for whatever we want in the government first, and the last thing we're going to pay are the bondholders. And so it's 100% a choice of Congress, who controls the budget and the Treasury, to default on the debt. We have enough cash flow, I believe, to pay the interest on the debt. Now, that won't be the case forever. There will soon be a day, if it hasn't come already, and I haven't done the math on this specific thing, so it's possible it's already come already, but if it is, then we're really long in the tooth, where there isn't enough money coming in taxes just to even pay the interest on the debt that's already been accumulated, and we have to borrow more money just to pay the interest. That's true. But currently, we have enough cash coming in, I believe, to pay the interest, but we do need to borrow more money if we're going to roll over those debts. And, of course, keep expanding. Because what the government really wants to do is they want to keep spending more and more money, and so they have to keep growing the deficit. They don't have to default on the debt, because what they would do if the debt ceiling was not raised and they didn't want to default on the bonds is they would take all the money that comes into the government, pay the bondholders first, roll over the bonds that are there. So again, they're only paying interest. They're not going to pay out the principal. And they're just going to run right up to the debt ceiling and keep it at, 20 whatever trillion it's at, upper 20s, and maintain it there. And whatever money is left over in taxes, they can spend to run the federal government, which will be very little. And everything will, the whole U.S. system would collapse at that point, because when they say defaulting on their debt, the debt that they're not worried about defaulting on the debt of the bondholders so much as they are defaulting on the debt of Medicare, Social Security, the military, all that stuff. That's what Congress is much more concerned about, and of course all of their goodies that they pay out to all of their local party members in various jurisdictions across this country. So getting back to the bond market, if there was any chance of a default happening, the bond market would be pricing that in. Even if, I'm not saying that bonds would be worthless, I'm saying that the price would be dropping. The yield would be rising in order to add in a bit of a risk premium. Currently, bond yields are negative in real terms. All the way out the yield curve, bond yields are negative. And again, that's in real terms, not nominal terms, which just means that the yield on every Treasury bond is below the rate of inflation. And so if yields aren't high enough to even account for inflation risk, they sure aren't high enough to account for any real default risk. So the default risk, we can assume, is absolutely zero. And the folks who have the most interest in knowing what the default risk is are the people in the bond market. Now, one counterpoint to that is that a lot of the utility for bonds, the reason why bonds can have negative real rates is because they have utility other than the yield and safety. Because if you buy a Treasury bond today, that's going to result in a capital loss over time. If you hold that Treasury for any period of time, unless unless you're buying it as a speculative bet, because you bet that yields are going to go even more negative, then you could sell it later at a higher price. But assuming you're not doing that, the other utility for treasuries is as collateral in the repo market. And I've been talking about this a lot lately. And the repo market usually is overnight. It's short term either way, but I mean I believe most of the repo market is overnight. So that means that even if there was going to be, even if, let's say, at the end of August, just throwing a date out there, the U.S. government we know is going to default on their debt. As long as those treasuries are still accepted as the best form of collateral in the repo market, even if people know that those bonds will be defaulted on, they have a reason to buy them because they're borrowing overnight. They only care about overnight. They don't care about what happens 30 days from now, 60 days from now, 90 days from now, a year from now, 30 years from now. They don't care. They could care less if the U.S. at some point in the future defaults on their debt. What they care about is that right now, they can use that treasury bond as collateral to get cash so that they can go speculate on stocks or junk bonds or some other crazy derivative. And so there's always that too. So I guess it is possible that there is this default risk, but it's just not being priced in because the demand for treasuries in the repo market is so strong. But if there really was a default risk, think about this for a second, wouldn't the repo market then say, you know what, the repo market participants think to themselves, you know what, do I really want to accept this treasury as collateral? Because if my counterparty defaults on this repurchase agreement, on this loan, and they don't pay me back, and they're putting up this treasury as collateral, and I'm stuck with this treasury, well, then there's a chance that I'm stuck with this treasury at the end of the month when it gets defaulted on. So why would I accept this as collateral? You would think then that treasuries would be trading like junk bonds, because junk bonds, there is decent default risk. And that's why the yield is so high. The yield has to be high in order to attract buyers. That's the beauty of a real market. Now, again, you could say, well, our markets are heavily manipulated, and I'll give you that. That's absolutely true. But they do still function to a certain extent. There is still some market participation in there, however limited. Even though our prices are, we're led to believe, largely set by a Politburo, known as the Federal Reserve, I'm not entirely convinced that their power is absolute to set prices. I'm more skeptical than I used to be, which again should be a source of hope. I hope that the Politburo, known as the Federal Reserve, doesn't have absolute 100% control over market prices. And so as you can see, I'm torn on a lot of this. Now, one last thing I'll say is the end of the eviction moratorium. This is another thing that might be throwing the bond market a curveball, or the market a curveball, which is contributing to this continued decline in bond yields. And again, today's move was not massive by any means, but it's a part of a trend. That's the only reason why I'm talking about this, is because things are moving in this direction. Risk assets are all highly correlated. When you're looking at junk bonds, real estate, and stocks, they move in the same direction. And the end of this eviction moratorium is I won't call it a black swan event by any means, and we've known this is coming for a very long time, but it certainly presents a risk to the real estate market. And if there is volatility and uncertainty in one area of risk assets, that is going to have ripple effects on other risk assets, i.e. stocks and junk bonds. And what is the solution for a lot of these big players like hedge funds when their positions in stocks and junk bonds might experience some volatility? Well, they want to load up on treasuries. They want to increase their treasury allocation in their portfolios so that they have some insurance, so that they can borrow against that in the repo market to continue to finance their leveraged risk asset purchases. And we've been hearing rumblings about some weakness in the housing market starting to bubble up. Again, I don't know that it's there. I'm not going to get my hopes up. But if insiders are seeing that, that would be bullish for treasuries. So, with that said, I guess I'll see you folks back here tomorrow.